dear students, to the massive open online course on money and financial markets. In today's module, we are going to discuss about the Keynesian money supply and the interest rates. The objective of this module would be to really understand what are the effects of an increase in money supply on the interest rate. In doing so, we would first recapitulate what exactly we mean by the Keynesian money demand and money supply, what are the factors that determine the Keynesian money demand function, and then how the interest rate is determined. And from there we will see that if there is any change in the money supply, in whatever ways does it affect the interest rate. Now we all know that what Keynes had in mind was, when he talked about the money demand function, there were certain motives for holding money. But before we go into that, let us try to get it from the scratch. Whenever we want to talk about any market, we basically need a demand for that commodity or money and a supply of that. So until and unless we have these two concepts, we cannot get the equilibrium point, which in the context of the money market, it basically implies the equilibrium is the equilibrium rate of interest. Okay. Now, when I talk about the demand for money in the context of Keynes, he considers that basically there are three motives for holding money. Initially, the main motive of holding money is the transactions motive. According to Keynes, he considers that people will usually keep some amount of money in their hands to carry on their day-to-day purpose, their day-to-day transactions, and to do that they need some money in their hands, and that is what is essentially called the transaction motive for holding money. And obviously that depends on the level of income of that person, right? So this means that if any individual has a higher level of income, as the level of income rises, then obviously the transaction demand for money is going to rise. So we can say that the transactions demand for money is positively related to Y, or the level of income. Next, we come to the concept of the precautionary demand for money. The precautionary demand for money implies that we need to keep some amount of money for contingency purposes, for emergency purposes, and this also depends on the level of income. And again, this is also positively related, because the more level of income we have, that will lead to more and more keeping aside money for precautionary purposes or for contingent events. The third one is called the speculative demand for holding money, and this depends that how much amount of money we are going to keep for speculative purposes, and this basically does not depend on the level of income, but rather it depends on the rate of interest that is prevalent in the economy at that point of time, and it is negatively related with the rate of interest. So as the rate of interest rises, the demand for money in the speculative scenario drops, and vice versa. So these are mainly the three motives for holding money. But since we found that the first two motives of holding money, that is a transaction motive and the precautionary motive, both depend positively on the level of income, we can thus club together these two motives of holding money, and we can just call them the demand for holding money, which depends on the level of income, or Y. And the other one, that is a speculative demand, which we call will depend on the rate of interest, which we call I. So the money market can be represented by the equation M by P, which is, as you can see in the slide, M by P is equal to L, which is a function of Y, comma I. Now what is M here? M is obviously the supply of money. Here P denotes the price. So this M by P basically denotes the supply of money in equilibrium. So the real supply, real balances in the equilibrium, okay? And the money demand function is basically given here by L, which is basically the liquidity preference function representing the demand for real balances, which is positively related to Y and negatively related to the interest rate I. So we can say that the money demand can be written as MD, which is equal to P into L, which is a function of Y and I. So I hope now you can understand that the demand for money is obviously it is negatively sloped. Because why is it negatively sloped? Because we will take on the vertical axis and on the horizontal axis. On the vertical axis, we are going to take the interest rate. On the horizontal axis, we are going to take the money supply. And here we can say that the money supply is vertical, and while the money demand function will be a negatively sloped curve. Okay. Now we are going to look at how the change in money supply may have different effects on the interest rate. One thing is very clear. Interest rate is the equilibrium rate of interest in the economy is determined by the intersection of the demand for money curve and the supply of money curve. Where they meet, that gives us the equilibrium rate of interest. Now we say in this module that a change in money supply may have basically three different effects on the interest rate. One is called the liquidity effect, then we have the income effect, and the third effect is called the price expectations effect. Now the effects that I have been talking about here, this does not occur simultaneously, but rather it tends to be spread out over some period of time following the changes in money supply. The effects move the interest rates in different ways and also to different extent. It can also be the case that one effect may even cancel or overwhelm the earlier effect. And so the final magnitude and the direction of effect depends on the economy's level of output and employment. So firstly, we will try to discuss what we mean by the liquidity effect. Now this effect represents the initial reaction of the interest rate to change in money supply. Because as money supply increases, that means the money supply schedule will shift to the right. So as the money supply increases, the interest rate should fall. Now the money demand is given, and as the money supply increases, the money demand function is constant. As the money supply increases, it shifts to the right. So the equilibrium interest, the intersection of the money demand and the money supply, the equilibrium interest rate is automatically brought down. How can we intuitively analyze this? Now as the money supply increases, there will be an excess supply in the money market. And if there is an excess supply in the money market, then obviously this will correspond to an excess demand in the bond market. So whenever there is excess demand in any market, in this case the bond market, the price of the commodity in that market is going to rise. So here we find that since there is an excess demand in the bond market, bond prices will eventually rise. And we also know, we have learned in our previous modules, that there is an inverse relationship between the rate of interest and between the price of bonds. And given this inverse relationship between the rate of interest and the price of bond, when I say that there is an excess demand in the bond market and this leads to a rise in the bonds, eventually this essentially implies that this is going to lead to a fall in the rate of interest. And so we find that interest rate falls in the economy. If we try to explain it in some other way, we can also say it in this way, that the central bank can increase the supply of money by buying bonds, and this raises the excess reserves and allows the banks to offer more loans. So, when we find that the demand is unchanging and with an increase in the money supply which amounts to a rightward shift of the supply curve, this will cause a fall in the equilibrium interest rate. So this is the diagram that I was talking about. As I said already, that on the vertical axis you will have the interest rate, as you can see in my cursor. The horizontal axis denotes the supply of money, and here this downward sloping line basically shows us the demand for money schedule. So it's a negatively sloped or a downward sloped curve. The money supply, the initial money supply is shown by a vertical straight line which is MS0. That means that the money supply is exogenously determined. We have no power to change the money supply in any way. And so when the money supply is MS0, it intersects the demand for money here at this point, as you can see in my cursor, and the equilibrium interest rate is given by I. As the supply of money rises, we find the money supply schedule shifting to the right to a new line MS1, and it intersects the demand for money at a lower point, that is at a lower level of interest rate I star. So here I star denotes the equilibrium interest rate, and this is exactly what we mean by the liquidity effect of an increase in the supply of money, which essentially leads to a fall in the equilibrium rate of interest in the economy. Next, we come to the concept of the income effect. Now, whenever money supply rises, we call it generally leads to expansionary effects in the economy, and whenever money supply decreases, it leads to contractionary effect. Now, since in all my diagram and in all my previous discussion, I've been talking about an increase in the money supply. So let us take this example only. We stick to this example. That is, we talk about the increase in money supply or the expansionary effects of money supply. Now, whenever money supply increases, what happens? That means in the economy, more loans are available, more loans are extended to the common man, more people are hired in the economy, or even if I say that more people are not hired, those existing workers are working for more hours in the economy, and hence people have more money in their hands. So consumers and producers, both of them try to purchase more goods and services. So in other words, it's achhe din. You mean people are happy, everything is happy. Okay. So an expansionary money supply raises income in the economy. Now, an increase in income, it essentially leads to an increase in the demand for money. If you remember, when I said that one of the main motives of holding money is the precautionary motive and the transactions motive. And I said that these two motives basically depends on the level of income, and it is positively related to the level of income. So whenever income rises, this component of the demand for money will essentially rise. So this means that whenever there is an increase in income, which is made possible by the expansionary effects. So what happens? There will be an increase in the demand for money, and as I have already said, because the demand for money is a rising function of income. So a rise in income will shift the demand function, and it will increase the amount of money that the public will want to hold at any given level of interest rate. So for a given money supply, a higher demand for money essentially will lead to an increase in the interest rate. Going further, we can say that as money demand rises, there will be an excess demand in the money market. So as I have already said that whenever there is an excess demand in any market, the corresponding price of that commodity in that market will essentially rise. That means that whenever there is excess demand in the money market, the rate of interest, that is the variable that measures the price of that market, that will also rise. Now, if we assume that households hold only money and bonds, so whenever there is excess demand in the money market, eventually there is going to be an excess supply in the bond market. So whenever there is excess supply in the bond market, that will lead to a fall in the price of the bonds. And as I have already said, that there is an inverse relationship between bond prices and the rate of interest. So whenever bond prices fall, essentially the rate of interest will rise. So I tried to explain it in two ways. Number one, I try to relate it with the fact that whenever there is a rise in money demand, there will be an excess demand in the money market, and whenever there is excess demand in any market, the price corresponding in that market will essentially rise. So interest rate rises. That's one way of explaining it. Another way of explaining it is going about the roundabout way with the bond market. So since people are holding only money and bonds, so whenever there is excess demand in the money market, eventually it means that there is excess supply in the bond market, and whenever there is excess supply in any market, it eventually leads to a fall in the price of that market. So that means a fall in the price of bonds. And as price of bonds and rate of interest are inversely related, again we come to the same conclusion, that interest rate rises due to a rise in the money supply. So here again we look at this diagram. We have again the same axis. We have supply of money on the horizontal axis and the interest rate on the vertical axis. Here, for a given money supply, so our money supply is remaining fixed, MS. Now, my initial demand for money is MD0. So, MD0, my initial demand for money, my rate of interest is I. But now, due to expansionary policies or so on, we find that there has been an increase in the demand for money. So due to an increase in the demand for money, we find that MD1, this has shifted up, and this leads to a higher rate of interest, I star. So this is what we mean by the income effect. So this means that in the previous diagram, this is the income effect of monetary expansion. That means as income increases, because income have increased, because I am explaining this once more, you have to understand this. It is not that the money demand is rising at one go. It is implying that when there has been an increase in money supply in the economy, it has led to an increase in income of the people. And because of an increase in the income, again it leads to an increase in money demand, because money demand depends positively on the rate of income. So it is not that money demand has increased at the first time. First, money supply have increased. Because of a rise in money supply, income of the people have increased. Because of a rise in the income of the people, this has led to increase in the money demand. And that is why the money demand have shifted. So please do not confuse this. And then we find that as the money demand have shifted from MD0 to MD1, we find that since money supply is remaining constant, the rate of interest increases from I to I star. Now, no empirical data or economic theory can predict whether the income effect of a money supply increase will override the liquidity effect, or if so, after what interval of time. It is impossible for us to tell. Under most circumstances, the income effect is likely to reverse some of the liquidity effect. But the relative magnitude of these two effects depends greatly on the state of the economy at the time the money supply changes. And then we come to the third effect, which is called the price expectations effect. Now, although an increase in the money supply is an economically expansionary policy, the resultant increase in income depends substantially on the amount of slack in the economy at the time of the action of the central bank. If the economy is operating at less than full strength, so an increase in the money supply will ultimately stimulate production, lead to more and more of employment and more of output. But if the economy is producing all or almost all of the goods and services it can, given the size of the population and the amount of the capital goods, then an increase in the money supply will largely stimulate expectations of a rising level of prices for the goods and services. So there is a price expectations effect which usually occurs only if the money supply grows in a time of very high output. This effect, so we can say that the price expectations effect only occurs when the economy is operating at a high level of output or near full employment level. An increase in money supply usually tends to raise expectations about the price level given the credibility of the central bank of that economy. And as expectations regarding prices affects the demand for real balances, it basically affects the interest rate in the same way as the income effect. So an increase in expected prices raises the interest rate. So if you look in this slide, we have the price expectations effect. I had previously in my first slide had written about the money market equilibrium condition, where I said it was M by P is equal to L function of Y comma I. But here we have introduced expectations. So we have to introduce a rule of expectations in the money market. So it is M by PE is equal to L function of Y comma I. Here PE is the expected price level. So the demand for money in this context is PE into L function of Y comma I. So as the expected price level increases, the individuals will demand a higher stock of money, okay, because they feel that prices are going to rise. And this will raise the money demand, leading to an excess demand in the money market. So again, if there is an excess demand in the money market, there will be an excess supply in the bond market, and again the bond prices will fall, which eventually, because of the inverse relationship between bond prices and the interest rates are going to increase. So here again we see we have the diagram here, where again our money demand function will shift to the right upward, leading to, and since my money supply function remains constant, at the same point my rate of interest will again rise from I to I star. So again this is explained that an increase in the expectation regarding prices will raise the demand for real balances from MD0 to MD1. And given money supply at MS, this will lead to an increase in the interest rate from I to I star. I would like to reiterate here once again that the money demand function increase does not take place at the first case. First case is the money supply rises. As the money supply rises, people's expectation regarding prices rises, which raises the demand for money. So here again, this rise in the demand for money is a consequence of a rise in money supply. So we can end this module by saying that increase in money supply basically has three effects on the interest rate. One is the liquidity effect, the other is the income effect, and the third effect is the price expectations effect. And these effects do not simultaneously occur together or in the same direction. While the liquidity effect lowers the interest rate, income effect and the price expectations effect tends to raise the interest rate.